All right. Good morning and welcome, everyone. This is James Orr, and I'm the type of dog that likes to start on time. So it is 9 a.m. And we are here for Real Estate Investor Story Time. Woo! So this is the second version of this class, second kind of story time class we've done. Last week's class was about Andrea. And the feedback we got was that people like story time. So today we are back with a totally different story. This one happens to be about Bad Luck Bobby. So let me tell you a little bit about Bad Luck Bobby, and then we'll kind of walk through what his numbers look like and how his situation turned out. We are live, so if you do want to ask questions or ask for clarification, you can use the chat window. If you want to have everyone see your question, which I'd probably prefer, unless you're going to get crazy on me, go ahead and do all panelists and attendees, and they will be able to see, and then everyone will be able to see your question, and hopefully I'll be able to reply to your question and answer any questions that are lingering for you. So let's talk a little bit about Bad Luck Bobby. Maybe you've known someone like this, sort of like an Eeyore-ish character, or Pigpen, a kind of character where nothing seems to go his way. This is the type of guy that in high school asks a girl to prom, and she tells him, I wish you would have asked me earlier, because I would have totally gone with you, but Billy asked me earlier today, and I said yes to him. He was kind of like my safe choice. So this is that type of guy. Type of guy that shows up to get free tickets to a concert, and literally the group right in front of him gets the last set of free tickets, and they turn him away and say, sorry, bud, we're out of tickets. Can't let you in. That's the type of guy Bobby is. There's one good thing about Bobby, though. He did happen to get a good job. He does tech support type stuff. And he's been saving up his money. He's 26 years old. He's been saving up his money. And by saving up his money, my wife is playing with the garage door. I'm wondering if she's able to get in. Oh, it sounds like she is. Anyway, so Bobby has been saving up his money thinking, hey, listen, this real estate market's been going really strong. I got to get in on this. I hear about all these people online. They're doing really, really well. The market's appreciating. Rents are going up. It's going crazy. I need to invest in real estate. And Bobby starts saving money for a down payment. And he doesn't study that hard because he thinks he needs 20% down. So he's been pushing really hard on his savings rate. He has he has a good job where he earns about $5,000 a month gross. He's able to save about $1,000 a month. Pretty good saver. When everything goes bad for you, you tend to learn how to prepare for a rainy day because it always seems to rain. That's kind of Bobby's philosophy. So Bobby's been saving about $1,000 a month. He's able to save up about $30,000 total. And he thinks to himself, I need to save up 20%. He happens to be in a market where he can buy properties for about, $250K. Sort of like Andrea. So Bobby's been saving. He's got $30,000 saved up, not quite enough for 20% down to buy a property. And all of a sudden he discovers this crazy thing called Nomad. It's like, Nomad, this is really interesting. You mean I don't need to save up 20% to buy a property? Nope. You can buy a property with 5% down. That's really interesting, Bobby thinks. So Bobby starts doing some math. He says, okay, I want to achieve financial independence. I hear about all my friends. They're all fire. They want to achieve financial independence. They want to retire early. Bobby's job requires a lot of hours. It's a little bit stressful type job. And so he's like, I make good money. And this is one of the few things that has gone well for me in my life, but not sure I want to do this forever. And so he starts thinking to himself some really rough math in his head. This is the sort of math that Bobby's doing. He says, okay, I've got about $30,000 saved up. I've got the ability, because of my income and the fact that I live below my means, I don't have a lot of extra bills. I have the ability to save about $1,000 a month. And so I could save about $12,000 a year. And by saving $12,000 a year, he thinks to himself, okay, so let's say I was able to save up over 10 years, $12,000 a year for 10 years, about $120,000. Okay, so I have $120,000 saved, and I have $30,000 right now. So let's say if after 10 years I have $150,000. And instead of really doing the math and making a spreadsheet and doing this correctly, he just says, okay, what if I pretend I had $150,000 today? He's on the discussion forums in the FIRE community. He says, okay, I understand this concept of this safe withdrawal rate, of how much money I could have taking out of my investments and kind of live on that and retire early. And so he says, okay, with $150,000, if I started with that today and I gave it a year invested in the stock market and I assumed, a conservative number for stock market numbers, we're going to use 7.2% per year, only because it makes the math super easy with the rule of 72. And the rule of 72 basically says you take the interest rate you're earning and you divide by the, let me think about this. Rule 72 says you take the interest rate you're earning, you divide by 72, and that gives you the number of years for your money to double. I think that's what the rule is. So he says, okay, with the rule of 72, if I'm earning 7.2% per year, it's going to take me about a decade for my money to double. So if I could magically wave a wand and I had all the money I was able to save in the next 10 years today, which I can't, and I had $30,000 I'm starting with, I had this $150,000, I would have, at the time I'm ready to retire, about $150,000 times 2. So about $300,000. If I were to use the 4% safe withdrawal rate, 4% of 300,000 times 0.04 equals $12,000 a year. I'm living on about $4,000 a month right now, or about $48,000 a year. That's not enough. I got to come up with another plan. And so he starts really thinking about this real estate thing. He says, okay, you know what I'm going to do? I'm going to do this Nomad thing because I obviously want to get better returns than what I'm seeing in the stock market. And I'm going to go ahead and just use part of the down payment I've been saving up. Instead of 20% down, I'm going to do this 5% down. I'm going to buy a house. So what Bobby decides to do is he's going to do Nomad. He's going to Nomad, and he's going to decide each year if he wants to do it. But he's thinking at the onset, I'm going to do this 10 times. And hopefully, fingers crossed, I will be able to retire early, maybe 10 years in. What's the saying? Something about I make plans and God laughs or something like that, right? So bad luck Bobby is in for a little bit of a surprise. So let's get started and look at what's going on, Bobby, here. I'm going to pull up the blueprint. And we're going to just start with Bobby buying his first house. He's going to buy this house. Originally, he's going to purchase his first property. It's a $250,000 property. He's going to put 5% down. So the down payment is going to be about $12,500. He estimates his closing costs to be about $2,500. His total amount that he needs to spend is about $15,000. He had about $30,000 in his bank account, so he's got plenty of money to cover that. He moves into his property. But you know what happens? It's unfortunate. Wouldn't it be just Bobby's luck that as soon as he buys his property, that's the peak of the market? It's crazy. Market's been going up and up and up and up and up. Rent's been going up and up and up and up and up. It's been a crazy strong market, and just so happens the month after Bobby buys, markets start going to crap. It's in the pooper. So Bobby owns one property. His net worth is about $28,000. He had a little bit of money left over after his down payment, $15,000 or so. He had that invested in the stock market. The stock market's a little variable. And he spent a little bit of money on closing costs, but he has some money in equity. So his overall net worth right now is just under $30K. His total account balance, he's got about $15,794 saved up in his stock market account. And his gross paycheck, he's earning about $5,000 a month. We talked about that. His paycheck after tax, his tax rate, I think about 21% or something like that, is $3,902. His expenses, not including the rent or the mortgage payment in this case, is $1,680. And so he's able to save, not including his mortgage payment, about $2,200. With his mortgage payment, he's end up saving about $1,000 a month. And this is what he would need in order to qualify. So here's how it was. He bought a property. He ended up with about $15,000. His account balance was increasing because he was saving about $1,000 a month. He's a saver. And then eventually he gets to the point where he has enough money and he's lived in the property for a year, because as a nomad, when you buy a property as an owner-occupant, when you go to closing, the lender requires you to sign a form that says, I am going to owner-occupy this property. I'm going to live there. And so you have to agree that you're going to own or occupy the property for 12 months. It's on the form you sign at closing. That's what determines how long we can live in this property. Okay, so Bobby decides he's going to sign that form. He lives in the property for a year, but then at the end of the year, he says, okay, now I'm going to buy another property. I'm going to convert this last one to a rental. And so he ends up saving up money. He has about $26,000 in his bank account, and then he puts his down payment down to buy his next property. Now the next property has gone down in value. This is like the same type of property he was buying before. It was $250,000. The market went down. Now it's $245,000, almost $246,000. So actually, even though he lost value on the first property, lost a little bit of equity in it, and probably rents are a little bit lower than he thought they were going to be, he's able to buy his second property at a small discount to what he bought the first. In some ways, you think about it as I'm sort of averaging my cost down. You know, if you buy something and you have to, you know, you need to buy this over and over again, you buy something and the price goes down, well, the next time you buy it, if it's at a lower price, your average price for what you bought went down. And if he does it again, his average price goes down, his average price goes down. So he sort of has a weird advantage, right? The market's going against him, which isn't fun, you know, especially when you're bad luck Bobby and everything goes against you. It's not a fun situation to be buying stuff when the market's going down. And psychologically, it is really tough. It's hard for somebody to say, hey, this investment I made, it doesn't look good, so let me buy some more. Because why not? The market went against me. I should just go buy another one. Doesn't that make sense? The property values went down. The rents aren't what I thought they would be. Let's go buy another one. That sounds like a great idea, right? It's like, hey, what am I doing here? So Bobby goes, he says, okay, I'm going to stick with the plan. Nothing ever goes right for me anyway. I mean, I should have expected this. So I'm going to go buy this property. And so he needs a little bit less than he did last time for his down payment. Still 5%, but 5% of a smaller number is less. His closing costs are a little bit lower. And so his total cost to close is a little bit lower as well. And so he buys the second property. Then he now owns two properties after that. His net worth declined a little bit, you know, partially because he's bought the property and he had some closing costs and stuff. Maybe the market went down. His total account balance, he had saved up for a down payment. Then he actually paid his down payment. So his account balance is only at like $12K now, a little bit less than $12K. You can see that. He has cash flow on his property. You know, originally for the first 12 months, he was just living in this property. He was supporting the full mortgage himself. Now, he could have gotten roommates. But Bobby says, you know, me and roommates, we don't really get along. I'm going to live in my own place. You know, I'm going to support the full mortgage myself. I'm not going to house hack. I'm going to just kind of live there and stay there myself. But then after he lives there for a year and he converts it to a rental, he says, hey, how much cash flow do I have on this property? And it turns out, including the tax benefits, because when you own a property and you have a rental property, you get your cash flow on the property, plus there are some tax benefits for owning the property. And we think of those a lot of times in terms of kind of like cash flow. I'm putting this in quotes, cash flow from the tax benefits or cash flow from depreciation. And when you take into account both the tax benefits and the cash flow on the property, he's still making about $89 per month in positive cash flow. That's the cash flow he's getting on the property. Even though the property value went down a little bit, rents went down a little bit, that's what he's seeing. Still has a good job, still earning, getting a little bit raise every once in a while. So he's getting his income's increasing. Now, really, this is sort of like inflation adjusted. It's about the same as what he was making. He's not beating inflation with his income, right? It's keeping pace with inflation. That's what we've assumed in this model for Bobby. Paychecks after tax, not going to go over that, same as before. In this case, total saved. He's saving about that $1,000 a month. It's a little bit less, but you know, give or take, it's about $1,000 a month. Okay. This shows you how much income he would need to be earning in order to be able to qualify for buying his properties. We can use the income from the rental property. Usually most banks are going to say 75% of the gross rents you're receiving. And then they'll say that can be counted as income to offset the expenses you have on the property. So they can count that as towards your income. And then this is how much he would need to make from his job. And he makes $5,000 a month, so he's fine. He's able to qualify for the loan. And so now he goes and he purchases his third property. And sure enough, property values went down again. A little bit less. So he had his account balance from the first property he bought was a little bit less, about 15K. Saved up, bought his second property, saved up. Now he's buying his third property. And at the end, once he pays his down payment, his third property is only going to have about $10,000 in that bank account. Okay. So his down payment, a little bit less than last time, $12,100 and change. Closing costs, a little bit lower, $24,000. And total cost to close, $14,000. So even though the market's going down, I mean, in some ways, he's got a little bit of an advantage by buying these properties and having them go down in value. Although the ones he owns kind of suck because they're worth less. Rents are down a little bit. So, but bad luck, Bobby. I mean, nothing ever goes this guy's way anyway. So it's sort of like expected. So he buys that property, converts the other ones to a rental. So at the end of that period of time, he now owns 3 properties. 2 of them are rentals. His net worth, about $40,000 or so, a little bit less. Total monthly rents, this is gross rents on them, is now about $3,000. So here are the rents on the property. Now they started when he bought the properties. I think they were about $1,500 or so. So he's got one that's actually doing a little bit better and one that's doing a little bit worse. So GN says, so he kind of lost a portion of the down payments for properties he's already purchased. Yeah, the properties were worth $250 when he bought them, and they went down in value. And so he's got less equity, just considering the purchase price, the value of the property. When he calculated in how much he's paid down in debt on the property, though, he actually made up some ground. But yeah, he's actually lost some of his down payment already. Sure. But you know what's interesting about Bobby's situation is, what is he doing? He's able to lock in interest rates today, and he's able to continue to acquire assets. And eventually, and who knows how long this will take, right? This could go on for 10, 15, 20, 30 years before properties start to go up in value. We don't really know. I mean, in this scenario, I know because I kind of like made it up. But this could be a situation where we don't know how long this is going to last. It could go on for 10 years, 20 years, 30 years. And so properties could keep going down. But he's now acquired these assets. This $250,000 asset. He said acquired another $250,000 asset and another $250,000 asset, maybe a little bit less. GN says, do the spreadsheets account for maintenance? They do. The software, Real Estate Financial Planner, absolutely accounts for maintenance. In fact, let's just go look at it because we can. So let's take a look at properties. And we'll look at maintenance. And I won't try to ruin the story for you, so don't look. We'll stop at like 36 months. So yeah, so here's the maintenance we're setting aside in the properties. About $150 a month on this one, and about $150 a month on this one. So yeah, when we're buying these properties, we do account for maintenance. We do account for vacancy. Let's take a look at vacancy. Vacancy. There you go. There's some vacancy allowance as well. So yeah, we are totally accounting for all those things. Okay. So continuing on with the story. So the cash flow, not including the tax benefits right now, on the first 2 properties he bought is negative $116 a month. So Bobby's like buying these properties and they're not even having positive cash flow. Now they do have positive cash flow, a little bit, we think, with depreciation of the tax benefits. But just looking at the cash flow from the properties, if you did your spreadsheet and you looked at the cash flow section, you would say, this is negative. Why am I doing this? Property values are going down. Rents are going down. Is this such a good plan? You got to question yourself. And so one of them is negative $116. The other one is negative $28. Total account balances, saves up for a down payment, does it. Saves up for another down payment, does it. Here's his account balance, about $10K. Here's his total cash flow when we take into account the tax benefits. Both of them combined is about $136 a month. Not a lot, right? Very little. Paychecks, we already talked about that. I'm not going to go over that again. So in this case, he buys another property. Property values are now worth less than $240. They were worth $250 when we started this. So now they're worth $239,802. Property values went down. Down payment for this one, just under $12,000 needed, and just under $2,400 needed in closing costs for about $14,388. So Bobby keeps pushing. He keeps going for this and buying properties even during this market decline. Is this going to end up tragically for him? Is this going to be horrific? Well, let's see. Let's keep going. So at the end of month 39, after he bought that last property, he now owns 4 properties. One he lives in, put 5% down. 3 other ones he bought that he lived in for a year each that are now being converted to a rental. So he's got those properties now as rentals. His net worth, just under $50K. Total month's rents, gross rents is about $4,500 a month. You can see what the rents are. Cash flow, all 3 of them are negative, some more than others. Total account balances, you can see him saving up and bought this property. His total cash flow from depreciation, now it's $275 per month positive. When you take into account the tax benefits and the cash flow, he's slightly positive. $275 a month. Not enough, not anywhere near enough for him to replace the kind of $4,000 that he's living on. He's making $5,000 from his job. He's saving $1,000. So he really wants to just get to the point where he can replace the $4,000 he's living on from investments. And then in theory, he could say, hey, listen, I don't need to work anymore. I've reached the point where my investments passively are throwing off enough money where I can live and I don't need to work anymore. So we kind of do that. Then he goes and he buys another property, saves up $1,000 a month about, and then he does another down payment. At this point, properties are worth $237,964. So the property that he originally bought for $250, that's worth $237. The one that he bought for a little bit less than $250, now that's worth $237. The one that he bought after that, now worth $237. So all these properties have declined in value. Kind of sucks to be him, but that's bad luck Bobby's way. So $14,000 total to buy the next property, less than $12,000, less than $2,400 in closing costs. And let's continue on. I'm going to kind of skip over some of the stuff. Here are the rents he's getting on the 4 rental properties. Here's the cash flow, all negative, not taking into account tax benefits. Total account balances. He's got about $13,000 at the beginning of the year when he bought that last property. His total equity in the properties, he's got about $50,000 in equity. James, how does that make any sense? His property values have been going down. How does he have $50,000 in equity? Well, how is equity defined? Equity is the difference between the then current value of the property minus your mortgage balance. Property values haven't been going up, so that's not been contributing to equity. But something interesting has been happening. He's been paying down those mortgages every month. And when his tenant moves in, the rent he's getting from them is actually paying down his mortgages. So this is super interesting because the mortgage is being paid down. And even though the property values are going down, it seems as though he's got more equity than when he started. Wow, that's pretty fascinating. So like the 4 areas of return when you buy investment properties, you have appreciation, the tendency for property values to increase. That's what appreciation is. You've got cash flow, your rents and other income on your property minus all your expenses on your properties. That's what cash flow is. You've got your tax benefits. That's basically the benefit the government gives you in order for owning rental property. And then you've got debt pay down, paying down on the loan. This is pretty fascinating stuff. So he's got some equity in his properties, even though we thought maybe he wouldn't have had equity. Maybe equity would have been decreasing. His total cash flow, including the tax benefits now for all the properties combined, is $262 a month. Really not significant at all. Still working his job, still getting a paycheck. He needs to be earning about $3,600 a month in order to be able to qualify for this next purchase, in case you're wondering. How is he able to qualify for these? Well, we use 75% of those gross rents, the bank does, in order to offset expenses on the properties he does own. And he has income for the rest. So he goes, and this is his account balance. The first one he bought, saved up, bought a second one, saved up, bought his third, saved up, bought his fourth, saved up, bought his fifth, saved up, now bought his 6th property. The property value is now $228. That's what they're worth. He saves out. He used to use about $11,400 for his down payment and about $2,200 for closing costs. So he needs about $13,700 to be able to buy this next property. Okay. Bought this property. Here are his rents on those properties, 1440 to about 1403. They kind of vary a little bit. His cash flow from about negative $150 to another one about negative $150 to negative 100 and change, negative 86, negative $50 or so. So he's got all negative cash flow on all these properties that he's acquired. When you take into account the tax benefits, though, they're actually positive. Total equity, $67,000. Again, that's increased. Total cash flow, including depreciation. In this case, it went down a little bit. $150 a month total between all these properties. And GN says, were these with roommates? And no, Bobby says, I'm not willing to house hack. You know, I like my personal space. I work really, really hard during the day. I want to come home. I want the house to myself. I need my own private time. I need to do whatever I do there, you know, play some video games, relax, read. You know, I am actually not willing to have roommates. And so, no, he does not have any roommates in the situation at all. He is not house hacking. He's got his gross paychecks. Still saving about $1,000 a month. Now he needs to earn about $4,100 a month in order to be able to qualify. And he went and he buys another property. $222,686. That's what the properties are worth now. He needs about $13,000 in small change in order to buy it. But then something magical happens. The market starts to turn. He's waited this out. He's acquired all these properties. It's taken him 6 years, 7 years. He's been investing despite the market going against him, despite rents declining, despite property values going down. And the market starts to turn around here at this point. Month 72, 6 years in, is when he's able to eventually get to the point where the market starts going up. And it doesn't go up crazy. You know, it can go up and down each month, but it's on average going up about 2% a year. Same as the inflation rate. And CC says, by the way, with the negative cash flow, that will impact his $1,000 savings per month since he comes out of pocket for the summation of those negatives and hence the speed of savings, but ultimately shouldn't affect the scenario as a whole. So yeah, in theory, that's how it works, right? Like you basically say, I'm not saving $1,000 a month positive, like $1,000 a month for my job anymore. Any negative cash flow I have for my properties is going to be offset from that. So part of my monthly savings would offset the negative cash flow if it were truly negative. In this case, it's not, right? Because with the tax benefits, it's still slightly positive. It's that $120 a month positive cash flow, you know, with the tax benefits. So really, you're right. If it was truly negative, even with tax benefits, it would offset that savings amount. Like you'd use some of the savings to say, I'm paying negative cash flow, which in my mind, the paying of negative cash flow is sort of like financing the down payment you didn't make. Because if he had put 20% down instead of 5% down, and he didn't have PMI, which he does in this case, but if he didn't have those things, he actually would have positive cash flow in this case. But he didn't. He put 5% down, and the market went against him, and so he's got negative cash flow. But with the tax benefits, it's still slightly positive. So yeah. So his net worth at this point, and it starts turning around because now all those properties that he was buying on the decline, you know, he's basically bought one when property values went down. I'm going to buy another one. I got a dollar cost or dollar value average in. Kind of think about it that way. You know, go buy another one when the market goes down. Buy another one. Buy another one. So each year he's buying down. Now he's got these 6 or 7 properties. I don't know how many it is right now. We can go look at it. And now they're saying, oh wait, now all of these are starting to turn around and they're starting to go up in value. That becomes super interesting. His total monthly rents now between all the properties, $8,421. And here's what they are. $1,427, $1,429, $1,403, $1,411, $1,350, $1,399. So they're all less than the $1,500 we kind of started with. That's approximately what they were. This cash flow, still negative. I mean, it's not like the market turned around overnight. It's not instantaneous. And honestly, for all he knows, this could be a one-year blip where the market's been going down for 6 years and the market just goes up a little bit and then it could go back down for 6 more years. We don't know. And that's the hard thing about a lot of this investing stuff is you don't know if you're at the peak. You don't know if we're going to have another coronavirus equivalent. So he's got all this negative cash flow, negative 157, negative 102, negative 94, negative 81, negative 190, negative 127. He's got a bunch of negative cash flow. This is not including the tax benefits, though. When you include those tax benefits, this total cash flow with depreciation, when you add them all up, he's still positive overall between all the properties combined, positive $62 a month. Squint really hard, he's basically break even. Cody says, what does his debt to income look like at this point? And so I don't have, unfortunately, I need to make a chart for debt to income. What I have instead is I have a how much income he would need to make in order to be less than 45% DTI. And so that is somewhere around here. Let me find it for you. So, whoops. How much income does he need to make? Here it is. So this is how much income he would need to be making in order to be less than 45% debt to income. And it is $4,487 per month. And he was making $5,000 a month in month one. So his income has gone up, about 2% a year. So he's way under that. He's way over that. He makes more money than he needs. So he's fine. Okay. So he's been saving up, buying a property, saving up, buying a property. He saved up again, bought another property. This time, the property value went up a little tiny bit. It's $229 now. $11,478 was down payment. Closing costs almost $2,300. So he needs just under $14,000 to buy this property. And he buys two more properties. I'm not going to kind of go through that with you. But at the end of that, he says, listen. In fact, let me do this. Let me do it this way. I'm going to show you something. I'm going to show you something interesting. So I'm going to say, all right, so let's take a look at the first 10 years of what's going on with this guy. And I'm going to pick a couple interesting things. So number one is let's take a look at the number of properties he owns. So he started off first month, he bought a property. Every pretty much year after that, he bought another property, put 5% down, moved into the property as a nomad, lived there for a year. So at the end of about 10 years, he owns 10 properties. Okay. His cash flow situation at this point, total cash flow, let's find that one. His total cash flow was pretty negative, not taking into account tax benefits. But by the time he gets to year 10, some of the properties rents have increased, and he's able to get to the point where he has $547 a month from 9 rental properties. One of them he's living in. He has 9 rentals. So he's able to get $547 per month in positive cash flow. When we take into account the tax benefits, the cash flow for depreciation, then he's really seeing about $1,750 per month, because that depreciation benefit looks like cash flow because he doesn't have to pay taxes on money. So he's actually getting more money back on his tax return, or he can go adjust his exemptions on his paycheck and see more money monthly. So in this case, he's seeing about $1,750 a month when he includes the tax benefits. So he says, okay, I really want about $4,000 a month in income to feel comfortable with me being able to stop working and retiring. But I'm really burned out. I mean, I've been working this tech support job for 10 years. My life has really never gone my way. It's been super stressful. I'm just done. At least I need a rest, okay? If I need to go get a job later, that's fine. But I'm not sure I can handle this anymore. I really need to take a break, okay? And so what he decides to do, let's see here. Gross paychecks. So what he decides to do is in year 10, 1 month into year 10, he quits his job. Now, that's like a surprise, right? Because, hey, I don't have that much money saved up. In fact, let's look at his total account balance. Kind of a risky move in some ways, right? He's been saving up down payment, saving up down payment, saving up down payment, saving up down payment, and now he's sort of making up some ground because he's getting a little bit more money in his bank account. Stock market's helping him. He's keeping his money in the stock market. But when he quits his job, he's only got $60,000 in savings. Not really even enough in my mind for like all of his reserves for his properties. But that's what he decides to do. He's like, listen, I need a break. I'm burned out. I'm going to stop working. I can always go back and get another job. But I think the market's looking really strong. I've got all these properties now. Rents are probably going to continue to inch up. I'll have some equity in properties. Let's take a look at how much equity he has. So he only has $60,000 in the savings account, but let's see how much he has in equity. If you decide to sell it with an agent and pay a 7% in transaction costs, 6% probably in commissions, and that, he still has about $300,000 in equity after expenses, after the cost of selling properties. So he's like, I got about $300K if I actually sold these properties, and I got about $60,000 in savings. I think rents are going up. I'm getting about $1,700, including the tax benefits right now. So I'm actually going to stop working and see what happens. So that's what he decides to do. He decides 10 years in, even in a declining market where the market went against him for 6 years, he says, I'm done after 10 years. I'm going to stop working, and I'm going to see what happens. And so he's got to dip into savings to make up the difference between his $4,000 in living expenses. That's what's going on. And he could, if things got tight, he could decide, listen, I'm going to go back to work and get another job. Or I'm going to go part-time. I'm going to go work at Starbucks or go work at the movie theater because I always like watching movies, and I could do this part-time and, kind of supplement my income. So I could do that. Or, hey, listen, I got this house. I got 2 or 3 extra bedrooms. I could rent out bedrooms, supplement, make an extra, whatever it is, $1,000, $1,500 a month. So he's got options, and he's got some equity. Okay. So he decides, hey, that's what I'm going to do. Let me see what I was going to go with this. So basically, he's got these properties. This is at month 111. Yeah, that's not what we're going to look at. What we're going to do instead is we're going to look at when he gets to the point where the amount of income coming in from his rental properties and a 4% safe withdrawal rate on the amount he has in the savings account, when would that support his full $4,000 a month in inflation-adjusted dollars? And it turns out that takes till month 305. But he stopped working at month 121. So here's his account balance. It's true cash flow at that point. So let's take a look now at what this looks like over time. I'm going to now extend it out and look at the full period of time. I'm going to close out some windows, clean up some stuff. Okay. All right, so let's take a look at his account balance, because that's one that's concerning to us, right? He only had $60,000 in there. Like, what does that look like? And so he stopped working around this kind of like month 120. Let's take a look at the first period of time here. So yeah, he stopped working here. He had about $61,000 in savings, and he's had to fund part of his lifestyle from a savings account. He's sort of like dipping into principal, something we don't often like to do, dipping into principal to kind of live while he's waiting for his rents to increase, while he's waiting for property values to kind of go up, although property values don't really have an impact. And so he's kind of like waiting for his income in retirement to increase. And so his account balance is dropping. And it looks like, I don't know, right around here, it sort of tapers off where the amount of money he's got coming in doesn't need to be added to anymore. So he's not dipping into his savings anymore. And that's pretty close to the bone, in my opinion. For him, he's like, if I need to go get a job, I'll go get a job. I'm okay with that. He's gotten down to $16,000. And that's at month like 177. Eventually, though, the rents start increasing, and he's starting to add to his bank account, and eventually he could basically live a lot higher lifestyle than he is, because he's got literally millions of dollars in here doing that. Okay? So let's take a look at what rents look like on some of these properties. Or let's look at cash flow. And in fact, let's look at total true cash flow. Oops. All right, so here's the cash flow on the properties. And I'm just zooming in a little bit. Because when he stops working, this is the one he's living in, so I'm going to take that one off. When he stops working right around here, he doesn't have significant cash flow on these properties. And that they need to keep increasing over time, and each one's independent, but they're going up approximately 2% per year. So that's what he's able to do. So in this case, Bobby was able to survive even through a declining market for the first 6 years. Market turns around, starts going up around 2% a year. Sometimes not always. Sometimes it doesn't go up that much. Sometimes it goes up a little more. Rents go up about 2% a year. Keeps pace with inflation, essentially, because that's what inflation is sent to here. And so he's able to do it. So that's all I got for you. That is Bobby's story. Bobby is able to buy properties even through a decline, stop working after 10 years, and he has been fine. Now, if you run this scenario, because it's random, but if you run this scenario 100 times, it will not always work out this way for Bobby. This is close. I mean, you saw his account balance. I mean, his account balance dipped. Let's go look here again. You know, there's a dip here. And if rents don't go up fast enough, or we have another decline or something like that, he might have to go back to work. Or he could sell some properties. He could sell a property and live off some of the proceeds for another, whatever it is, year or two. But then he'd have less in retirement. GN says, did he choose 5% down because that's all he had, or because he wanted to leverage? He chose 5% down in this case because he thought the market was moving without him. He was feeling fear of missing out. He had been saving up thinking he was going to put 20% down and buy a property. He had saved up $30,000. He would have needed $50,000 plus some closing costs in order to do it. And he's like, the market keeps moving. The market keeps moving. And he found out he could buy a property with 5% down as an owner occupant and then convert it to a rental. And so he figured to himself, look, it's going to be 2 more years, even with me saving $1,000 a month, for me to even get to the point where I can save up for 20% down payment. So I don't want to miss out. I want to buy a property now. And so he decides, he does some research. He says, this Nomad thing sounds interesting. I'm going to do one. I don't have to I'm not committing to a 10-year plan when I first do the first one. I'm saying I'm going to do one property. And then during that first year, continues to learn, educates himself, figures out this makes sense to me or doesn't make sense to me, whatever he decides, I'm going to either do another one or I don't know what I was thinking. I'm not doing any more of this. I got this one property. So he just bought one property, moved in, lived there for a year, decided to convert that one to a rental and buy another one. It was still faster for him to put 5% down and live in the property for a year than to convert it to a rental than it would have been for him to continue saving $1,000 a month and save up for 20% down. It would have taken him 2 years in order to get the down payment to buy the property. Or in this case, he was able to acquire the property, live there for a year, and convert it to a rental. He was still ahead of the game in his acquisition strategy by doing it that way. Okay? So this could have been tight. There were definitely scenarios where I ran where this did not happen. Okay? And so he played it super, super close to the bone, in my opinion, way closer than I would personally feel comfortable with. But, he was burned out. He needed the break. He needed the time. Any final questions? Otherwise, that is the end of story time. Do you guys still like this format? Kind of like a story format with little charts pushed in, kind of keeping it that way? If you would let me know, that would be amazing so that I can determine whether or not I've got my Tuesday mornings off or if I'm doing more of these. Yeah, Douglas says yes. Can you look at his final asset? Sure. So let's take a look at, total net worth. Total net worth. Net worth, here we go. Oh, it's the default chart. I should have known. So in this case, he's got, in inflated dollars, $29 million with that. If you adjust for inflation, after 60 years, because he was 26 when we started, so we did a full 60 years, so he's 86 years old, and if you adjust back to inflation adjusted dollars, it is just under $9 million in net worth. So honestly, he could have been spending a lot more aggressively once he got to a certain point than he was, because he ended up with a lot of money that he's going to pass on to whatever that looks like for him. Yeah. Candace really likes that format. Cece says, excellent. I must have missed some questions here. Gian says, yeah, can we do an expensive market like SoCal next time? Maybe. The challenge for me is I need to get excited about it. And so I'm sure there's a SoCal one coming. Whether that one is next, I don't know. So possibly. And says, thanks. You're very welcome. CC says, excellent. Thank you. Candace really likes this format. We talked about that. And house hacking with 2 to 4 units. Yeah, and you could definitely house hack. The chance of you house hacking multiple 2 to 4 units, like where you're buying 10 fourplexes, it's almost zero. The chance of you being able to do that, because lenders are not going to approve you for those loans. They may approve you for the first one for FHA, or if you're VA, for a VA loan where you get a duplex, triplex, or fourplex, maybe you can squeeze out 2 of them. But the chance of you doing more than like 2 at the outer edges 3 is almost zero. So Lynn likes this format. Yep. So yeah, I mean, you're not going to be able to house hack duplexes, triplex, or fourplex. You can house hack single family homes, or buy a single family home that's not really a duplex, that has sort of like a basement unit. But that's like the same as saying you're buying everyone and renting out rooms. It's just you have to be renting out rooms in the basement. So you could sort of like pretend that's the case. But yeah. And honestly, Jan, if you're doing house hacking and you've got better than regular rental income, the numbers look better. That's like all I can say about that. It's like you have a lot more cash flow. But yes, we can totally do that. How much in reserves do you target? This is a super interesting question, Cody. And I didn't actually give you money in order to come in with this question, though. So it turns out this is a very complex question. The very short answer is 6 months principal, interest, taxes, insurance, HOA on a property in some type of very liquid, very accessible, very low risk type of account, like a savings account. However, it is way more complicated than that, in my opinion. And I'm going to be teaching a class on all the new stuff I've been creating around that exact concept, reserves, and how much should you have in reserves, and how do you think about reserves, and all those other reserve-related type questions. I believe it's like the first week of October. It's like October 7th or something like that. It's on the Wednesday night class, and it is going to be amazing. I think the name of the class is like everything you learned about deal analysis is wrong, because all the new stuff that I've created around reserves completely changes how we do deal analysis, like forever. And so there's a whole class on this whole concept of reserves and how we think about them and how it impacts deal analysis and what we should be doing and all that other stuff. So there's going to be an amazing class coming up on October 7th about that. So that's the question. Cece says, for the Nomad, what kinds of responses works for the banks when they ask, why do you have to keep the previous house? They don't ask you why you have to keep the previous house. You tell them, I'm keeping it. I'm going to convert it to a rental. And they may ask you, why are you moving into this particular house? But I've never seen someone get asked, why do you have to keep the previous house? Never before. So if you get that one, write what you think is true. And if they say no, try another lender. But I've never run into that, so can't really say. Any other questions? You're very welcome. Very welcome. That's about all I have to say about that. So thank you, everybody. Have a really good rest of your Tuesday. I will post this up online for premium members so that they can go access this. I'm trying to figure out what I'm going to do with these, So I'll probably go do all that. And don't forget to come to class tomorrow night. Tomorrow night's class is about how to come up with down payment for investing. So it's going to be really good. That's it, everybody. Have a great day. I will talk to you all soon. Bye-bye for now.